investors are also maturing and investors are also aware now of equity markets. But there are right now 50 players, 2003 there were 35 players. So you mentioned how everything has become 10x, 20x, 100x. But in terms of number of players, they have not grown as much. So there is more room for more number of players because the 6 crore unique investors are going to become 15, 20 crores. The AUM which we have will be much larger than what it is today. So there is room. Risk-reward equation has to be in our favor. And what I mean is many times the best company is not necessarily the best stock. Portfolio return are a combination of buying good stocks and reducing mistakes. Our view is that we will manage it like a true flexi cap, where we will have a range of 40 to 60% large cap and the balance in the bottom.
In today's episode, we discuss the launch of Abakkus Asset Manager's first NFO with its founder Sunil Singhania, a veteran who began his investment journey when India's market cap was just a fraction of what it is today. He is currently heading Abakkus, but he has seen 3 decades of the market. 3 decades, what does it mean? 3 decades means, I think 30 years back, there were almost like 900 odd companies. Now we have almost 4,500 or 5,000 companies. Market capitalization almost 3 decades back was almost like 5 lakh crores. Now we are talking about 470, 480 lakh crores kind of a market cap. He joined us to share the philosophy behind this maiden NFO and what it makes for investors of HDFC security. Few words about your past before we go to the present.
No, I think what you said is absolutely right. India has grown 100x. Obviously, right. Some good funds have become 300-400x. I would say that as far as journey is concerned, we are all beneficiaries of the economy growing. And obviously, if you have confidence in the economy and if you remain positive, right. The benefits are always there. So I always say that if you have to sum it up, it is be positive. And I've been blessed with, good people I have come across. We always say that it's not only relationship, it's not only compounding of returns, but it is also compounding of relationship.
Definitely.
And I'm really, really grateful to HDFC Group. We started in 2018. And I think I have no qualms in saying that if it would not have been for the support they've given us, we would have not even been known as we are known now. Because ultimately you need some money to manage, right? To show your performance.
But tell us how much money, what all currently you're managing before you're venturing into new fund?
So, Abhishek, frankly, we have never had any targets when we started in 2018. We started with an AIF, we raised 1,200 crores. And after that, there have been challenges like COVID was a big challenge. But what we have tried to do is introduce products which we believe right. can add value right. to an investor's portfolio. Right. So we started with Cat 3 AIF, we ventured into PMS, right. we have a sort of a basket which we offer on our RIA platforms, we have a global mandate. Right. We launched our UCITS fund, own UCITS fund called Aryabhatta India Fund, which is domiciled in Ireland. Right. Last year we had a mid to late stage private equity fund, which did very, very well. And I think now as we move forward, investors are also maturing and investors are also aware now of equity markets. They want now to also look at a newer dimension of products. Right. I'm very sure that mutual fund is already well known. Yeah. But there are right now 50 players, 2003 there were 35 players. So you mentioned how everything has become 10x, 20x, 100x. Right. But in terms of number of players, they have not grown as much. True. And even now, out of the 50 players, maybe top 25, 90-95% of the market. Right. So there is more room for right. more number of players because the 6 crore unique investors are going to become 15, 20 crores. The AUM which we have will be much larger than what it is today. Right. So there is room. And obviously with newer products like SIFs also coming in, right. I think as a complete AMC, we want to ensure that we have what the investors would want and what would be good for them. So I think it's a good journey and we are here. Let's see.
The journey with Reliance was obviously highly rewarding. In fact, the journey in Abakkus, there are multiple products which have been launched, but all have given, or most of them have given 2 times, 3 times, 4 times, even some, I just read 4.5, 5 times was also returns over a period of time. So remaining invested is something which Mr. Sunil obviously very strongly talk about. So before we come to your new fund, which you have come up with, Abakkus Flexi Cap Fund, tell us something about your research, because that's what tell us something about your research and the entire team behind it.
So I think that is basically the heart and soul, because ultimately if you're not able to give consistent returns, then there is no need for us to exist.
True.
So I think I have been always a numbers person. And when we set up Abakkus in 2018, I think the first thing we did was get together and introspect all the mistakes which we have made in life. Because our view was that everyone is allowed to make new mistakes. We can't afford to make the same mistakes. And with that came in our philosophy. I think briefly the philosophy is that we want to be investors, not allocators.
Okay.
So everything we look at is from a return perspective and from an alpha generating perspective. The second most important thing is we are very number focused and very balance sheet focused.
Okay.
So sometimes you end up missing also some stocks which might appear to be expensive, but ultimately I have seen that it is always good to follow what you understand. So balance sheets, profits, profit growth. More importantly, I would say that risk reward equation has to be in our favor. And what I mean is many times the best company is not necessarily the best stock. If it is priced beyond perfection. And we have seen many times that there is mismatch of valuation which happens for 3 months, 6 months, 1 year, 2 year also. And investors get sucked into it despite valuations being very high. But ultimately, as I said, the best company might not necessarily the best stock.
True.
And on the basis of this philosophy, we created a framework, which we call it the MEETS framework, MEETS.
Okay.
Very simple. M is management. Now, everyone wants to invest in good management.
True, definitely.
But how do you describe? It's not that you are wearing good clothes, you have studied in colleges, okay, those traits are there. But ultimately, discipline of capital deployment. That is our criteria for good management. So we typically don't invest in companies where at least ROC is 14 to 15%.
Okay.
The E is earnings. As I said, we are very earning focused.
Right.
We believe that investing in equity is becoming a partner in the business. And we would want to become partner in a business where one, there is earnings. Second is where there is visibility of earnings doubling in 4 to 5 years. Because if the earnings double in 4 to 5 years, then even without P re-rating, we can expect to double in 4 to 5 years.
Sure.
Second is very important, event trends and disruptions. We are in a very disruptive world. The way we shop, entertain, study, work is prone to disruption. I give the example of newspapers, where disruption has led to advertisement shifting to the digital platform and the P multiples have collapsed. Or even the channels, our entertainment is now on the OTT platform, not on the old old channels or the cable channels and all. Or even passenger vehicle globally. Tesla trades at 200p. Other more well-known brands like Mercedes, BMW, and all they trade at 6-7p because there's a threat of disruption. So ultimately, market price is equal to EPS into P. EPS is earning, P is perception. If the P is fall, even with earnings being stable or growing, you will not make returns. So that is very important. T is timing. We can't time the market. But as I said earlier, there's a theory of mean reversion. If you buy something very expensive without underlying growth, the theory of mean reversion will mean that something will happen which will bring the valuations down. And in the current market, we have seen a few examples where because for some reason the stocks have fallen 30, 40, 50%. Because they are priced beyond perfection and therefore the smallest disappointment can break the back of the price performance. And last is the structural bit. We are value conscious, but India is a growing economy. India has sectors and companies which grow fast. There we will have to pay a slight premium. But that premium should be justified by the higher growth. So between the investment philosophy and framework is everything we do. The advantage of framework are twofold. One, as you rightly said, India has so many listed companies. Now, even with this large 22, 23 member team which we have on the investment side, it is impossible to track every company. So this framework ensures that we restrict or limit it to 430, 450 companies which are relevant. And the other thing is, frameworks help you in minimizing mistakes. Portfolio return are a combination of buying good stocks and reducing mistakes.
Definitely, yeah.
So I think this framework helps you in ensuring that you don't get carried away and make mistakes. And in a scenario where returns are going to be more modest than in the past, you can't just afford to make too many mistakes.
Right, definitely. So very well said. In fact, how you have briefed about your research, and because that's the core thing which you do. But coming to now Abakkus Flexi Cap Fund. So Flexi Cap as a strategy, I think everybody knows Flexi Cap is a strategy where the fund manager is free to allocate funds across large cap, mid cap, and small cap basis his own his and his entire team's view about which sector or where to participate. And there's a huge amount of investments. In fact, all the 50 AMCs, 49 or 48 AMCs we have Flexi, already have a Flexi Cap, and it's a very large segment. So, sir, tell us about what an investor should look in your Abakkus Flexi Cap.
So as you rightly said, it's a large, product in the mutual fund stable, and almost everyone has it. But as the name suggests, you have flexibility of investing anywhere and everywhere.
Right.
So as a first fund, obviously you need that flexibility, that you're not constrained by your product features to not look at one thing or the other thing.
True.
Second is generally and sincerely we believe that in this current market, you need this product.
Right.
Because the swings in prices across market caps,
Right.
across cycles, across styles, across sectors
Ji.
is huge. And you want to try and at least capture some part of it. So when I say flexi cap, it doesn't mean that I will go from 0% large cap to 100% large cap and back. That is not possible.
Right.
But our view is that we will stick to this 40-60% large cap. And the other thing is, in this category, there are some really large funds in the industry.
Right.
I think because of their size, they have become quasi-large caps,
Right.
where large cap exposure is 85, 90, 95%.
Yes.
That's worked in the last 1 year because large caps have done much better than the mid and small cap. But ultimately, I think our view is that we will manage it like a true multi-cap or a true flexi cap, where we will have a range of 40 to 60% large cap and the balance in the broader market.
Right. So I think simply if put across for an investor, there's a team behind who has already done study of couple of stocks, and from that they have filtered 482. And obviously this fund will not have 482 stocks. I think around 40 to 50 scripts.
So we intend to have between 45 to 50.
Okay.
And the idea is not to have very high concentration. It's a mutual fund ultimately.
Definitely.
At the same time, having a very, very long tail, with 0.1, 0.2% exposure, I don't think it adds too much value.
Right. So I think it's an ideal recipe where you have all categories of stocks. Obviously, the research team will have their own justification why they are participating, where or not, and then there are caveats in terms of how much you can participate in which category of stock and sectors and all. Now, sir, because since we are talking about stocks and the markets, before anybody invests, they always have a feeling that what they are looking forward for. I know 3 months, 6 months, 1 year, 2 years is very fairly short-term kind of a time frame for an investor. So 3 years, 5 years, or that's where you feel that this is an ideal time. I know people will try to judge you on the barometer, which is set up by yourself also very high, 22 years, 100 times returns. But here what you see, 5-10 years, where one should investor, he can just fill it, shut it, and it's like, okay, you are there to take care of.
One is frankly a disclaimer. See, when we were a $100 billion, $200 billion economy, to grow at 7-8% real, and because inflation was high, 15% nominal, with 17-18% profit growth was possible.
True.
Now we are a $4 trillion economy. Obviously with size also comes challenges of growing extraordinarily fast. It is very natural.
Definitely.
So, and the inflation has also come off. So as I said earlier, at 7% real GDP growth, we have 9.5-10% nominal GDP growth, and we are more mature corporate India than it was earlier. So corporate profit growth to that extent also will be slightly muted compared to earlier. And we are not at 5p, 10p. We are at 17, 18p. So we might not be extraordinarily expensive, but we are not cheap either.
Definitely.
So our view is that all the returns which we anticipate from the future are going to be on the back of the profit growth of the underlying portfolio.
Right.
So we don't bake in any P multiple in our return estimate.
Okay.
And our view would be that if you are able to create a portfolio where you can have 14, 15, 16% of underlying profit growth, then those kind of returns we can expect. And I think those are not bad returns. Our view is that from a 3-5 years perspective, India can grow nominally at 9.5-10%. Large cap profit can grow 11-12%, the broader market profits can grow at 14-15%. And we'll be very happy with returns which are around that.
Yeah, definitely. And then obviously with your research, there will be alpha. I'm pretty sure that's how it has been in
Only
past.
one thing,
Yeah.
we are in a phase where we can't afford to make mistakes.
Definitely.
Not only we, but overall as an investor community. So, I would say restrain your urge to play momentum and restrain your urge to try and double money every month.
So one question which has come up very strongly across investors is active versus passive. How? Because since this is an actively managed fund where you are identifying set of companies, and within those set of companies, again, you are applying your own filters to identify the companies which are meeting criteria and all. And there's a passive fund. So how will you place this bet as in terms of active is better than passive and something around it?
No, I think, see, both the categories of investments are going to be relevant, are relevant already and going to be relevant. Now, obviously, passive comes with its advantages, lower cost, simple product, At the same time, in a growing economy like India, you will have many new sectors come in, many new companies come in. You have the advantage of having such a large ecosystem where entrepreneurship flourishes. We are not very concentrated like some of the few other countries like Taiwan, where one company is 70% of the market, or Korea, where 3 or 4 conglomerates would be 50, 60, 70%. We are very, very dispersed and diverse. We have presence across sectors. And in that kind of a situation, you always get new themes, new companies, existing smaller companies which are growing faster, where you can research and try and add alpha. And so far, I think the industry generally has been able to do that.
Definitely.
So as long as...
Yes, I know.
No, even some of the other categories, I think. So as long as the industry is able to create that alpha, actives will be there. The passive also will become a very, I would say, potent, instrument. And as we progress, as the economy becomes larger and larger, maybe, in some of the categories, particularly large caps, it might be a segment which would be unaffordable to ignore. But it also comes with a little bit of, I would say, negatives. You will buy something only when it's a part of the index. And it comes in the index only when it has already grown significantly. So for active guys, the opportunity for us is to invest in something which is looking good, which eventually will become a part of the index, and then the passives will come and buy,
Great, sir. So broadly, I think we have understood the framework, we have understood. So probably 1 or 2 words about how you see, overall this economy progressing, because you touched upon that we will be growing, our GDPs is around 6-7%, and then because of inflation coming down, and nominal GDP will be around 10%. But anything as a big threat which you see in India, which could hamper such performances, if you want to highlight?
No, I think there will always be challenges, and as a country we are facing challenges. So one obviously is this tariff issue has dragged on too long. So from January, when it was first announced, I think we all thought that India and US were great friends and India would be the first of the blocks. And I think that was a very logical thought. However, it dragged down and we were slapped with 25% tariff, and then on top of it, an additional 25% tariff. As we speak, we are only one of the 2 countries with a 50% tariff. And time and again, despite all the goody-goody comments, the fact of the matter, it's still not done. So, last 1 month, I think the news flow is more positive, but, we need it to be done. Only news flows are not going to help. I think there is the talk now again in December, there is going to be a delegation from US which is going to come and discuss it. I think we need to sort that out. Because you can't drag on for too long. We are already seeing some segments in exports slowing down. I think October was a month when exports degrew. And because there's so much of clamor for gold, imports grew. And that's why we are seeing also trade deficit shoot up. And as a consequence, the currency also shoot up. So I think it's a cycle which we need to, now try and arrest. The other thing is there is too much of supply of fresh equity. Whether it is through IPOs, through offer for sales, through some PE selling, promoter selling. And I think that also needs to be a little bit, it needs to slow down, because what it is doing is it is not leaving any funds available to invest in the secondary market. And I think particularly the broader markets, we are seeing that having an impact. So I think these are the two near-term, I would say, issues which are plaguing the market. Otherwise, there is tailwind. RBI is in an overdrive. We have already had rate cuts of 125 basis points. We have huge infusion of liquidity. Government is trying to do its bit with GST tax rate cuts and income tax rate cuts, and hopefully in the run-up to the budget, there will be optimism that the budget will follow the same growth trajectory which they intend to do. So I think from a positioning perspective, I think markets are well placed. And our view is that after 15 months of consolidation, where no returns have been made in broader markets, slightly negative returns have been made, I think from here on we should look at with much more optimism.
Great, sir. Happy to hear. In fact, to all the investors who are listening to this conversation, we have Abakkus Flexi Cap Fund. The fund is open from 8th. And it is available till 22nd of December, and it is available across digital properties of HDFC. And please note that this fund, wherever you're looking at to participate, it's an equity fund, so you should have a long-term vision. Definitely, there could be a positive or negative upside. Don't get bothered. You are investing for long. Please invest with basis your risk profile. This fund has been shortlisted through HDFC research that itself talks about that we ourselves have understood what the fund philosophy will be. We know the pedigree who's managing the fund. We know the team who's managing the fund, and that's where it is come as a subscribe for our investors. So please have a look, discuss with your relationship managers, or take your decisions. The entire details will be available. So thank you.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.